Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Jocelyn Arel, partner with Goodwin Law, to discuss the increasing use of SPACs as companies go public to access the capital markets, including the all-common approach. Jocelyn, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. It's great to be here.
What is a SPAC and how does it work?
So from a high level, a SPAC is essentially a pool of money. The SPAC founders and sponsors take the company public and raise proceeds through the IPO. Those funds are held in trust and are available to combine with an operating company. And through that second process, essentially take that operating company public. So in its very simplest level, a SPAC is a public pool of capital in search of an operating company.
Why are they gaining in popularity and how are they different than an IPO?
They're gaining in popularity. I think a lot of people saw that through COVID, when COVID started, that a lot of the SPAC deals that we had underway, the combinations with the operating companies, that those deals were successful and that they closed, and they closed with the valuations that had been negotiated. And I think that seeing that aspect of it enabled more and more people to start to form SPACs and to view them as a credible alternative to initial public offerings. I think before this time, people were really seriously considering it. We were seeing more and more entrants over the last 2 years into the SPAC space, forming their own SPACs and going out in search of operating companies. You've seen a significant increase in the type and breadth of sponsors of SPACs really believing in the product. And I really think that having the onset of COVID and a lot of other M&A deals go by the wayside and be terminated, but yet seeing that the fact that the SPAC deals were able to make their way through these very, very choppy and uncertain markets really opened the eyes of a lot of market participants, whether they were new entrants forming their own SPACs, or whether there were operating companies that may have thought about it before and thought that this may have been a viable alternative, but really weren't willing to go down the path. So what I'm seeing today is just an ever increasing and broader range of market participants, both forming SPACs as well as operating companies. Every day we're reading about the next operating company that has chosen to go this route. So it's a very exciting time in the marketplace.
Where does Goodwin Law fit into the SPAC ecosystem?
We've been in the space for a really long time. I started back in 2004, really believing that this could be a way for mid-market tech companies to start to go public again after the dot-com boom, and that we had really seen a lull in companies going public. That you really saw larger companies, but a lot of the mid-market companies weren't going public. So we've been in the space for a long time, really believing in it. Now, everybody is pretty busy working in the SPAC space, but we are focused primarily in working with a lot of operating companies, taking those companies public through SPACs, as well as an ever-increasing number of SPAC sponsors and helping them through the IPO process, and then also finding the operating companies to combine with and really helping facilitate that whole process.
So what are some examples of SPACs that Goodwin has worked on in the past? And are there areas or sectors that you tend to favor more?
We favor the sectors that we really practice in. So we're set up in industry verticals. So it's private equity, real estate, tech, and life sciences. And the SPACs that we've been working on are reflective of those industries. For example, in the last 6 months, we represented Amadix in its de-SPAC transaction. It's a life sciences company based in Germany. We have announced Cerevel, which is another life science company based in the Boston area, closed a transaction for Open Lending, which was more of a public, a PE style transaction, but a fintech. So again, technology based. A couple of the SPACs that we've taken public recently were a SPAC called One, which is focused in the technology sector, Therapeutics Acquisition Corp, which was the first no warrant SPAC, and a lot of people asked, is a SPAC without warrants really still a SPAC? And one very recently that priced last night was a SPAC by the name of Ribbit Leap, which is a twist on this, the basic SPAC structure.
And you recently executed a transaction that was called All Common. Is that referring to the no warrant SPAC?
Correct. Correct. So that was the first deal that was done that was a pure no warrant. And by that, I mean the sponsors didn't pay additional funds and put additional funds into the trust account to make up for the fact that there were no warrants. There had been other SPACs that had no warrants, but that the lack of warrant coverage was paid for up front. In therapeutics, it was pure no warrants. There was no additional consideration put into the trust. And so again, that's a SPAC that just doesn't have that unit component. It's a pure common stock SPAC. And there have been at least one other that have followed in their footsteps.
And Jocelyn, to wrap, do you think more companies will look towards alternative forms of accessing the public markets, like a SPAC versus an IPO?
Absolutely. We're seeing that every day with the increase in companies that would really like to go public in this way. Um, in addition, I really think that companies now have a choice. You can do a traditional IPO, you can choose to go public through a SPAC, and then there are direct listings. So we're now in a new environment where companies have flexibility and they can pick and choose what fits their needs best.
All right, Jocelyn, thanks for joining us on Trade Talks.
Thanks so much.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.